Hey everybody, this is Brent from Wolf on Wall Street Trade. I didn't do a video last weekend, had a big birthday party and camping trip. But basically where we ended up last week, or the video that was posted on the 15th, was that the S&P had hit our measured move of 4,000, which we had called earlier in the week on Monday, basically that week, and hit it on Friday. And then the most common thing to happen after a measured move is hit is either a consolidation or a correction. We got more of a correction over here coming down than a price consolidation, which would be a little bit more lateral. But still, 3,900, and what I told my subscribers I was looking for, let me zoom in on this a little bit, was that for this test of 3,900 to be retested one more time and to make a higher low. So that's what happened right here. The test of 3,900 in the S&P, a higher low. That was a bullish thing. Now this could have turned into a bear flag right here. So we also needed to see some follow through on the upside, which we got over here. And this turned into a bull flag. But I'm going to come back to this in just a moment. But I do have to say, if you want to get the most from these videos, it's really useful to watch the prior video, the last week's video, and see what we were expecting, how things developed from what we were expecting, and where we are now. You get context. If you're a subscriber, then you see these things every single day, and you know what's happening. It's not just, every weekend. You're seeing 4, 5, 6 updates a day. Another big development that I've been looking for is for the mega caps, which have just really been the worst performers of a group of stocks in 2022, to start seeing some rotation and leadership. And there's really no sign of that before January started of 2023 of this year. But as we came into 2023, all of a sudden we're seeing slight signs, like I talked about in the last video on the 15th, that the communications sector had broken out. A few other signs that mega caps were seeing some rotation into them. And the reason that's important is because these are really heavily weighted stocks. A half a dozen of those can move the market more than 1,000 lightly weighted NYSE stocks. Like I said, we've been seeing signs of that. So if we just look at this last week's trade, the S&P 500 on the week closed up, I think it was about 2.5%. Yeah, 2.5%. And the NASDAQ 100, which is full of these mega cap stocks, closed up 4.7%. So we're already seeing relative strength in the mega caps starting to materialize, and that's really been something that's just happened in January. I'm going to show you a little different view here. So what we're looking at is the S&P 500, and this white line is just an equal weighted index of cyclical sectors, with the exception of one, which is consumer discretionary. It is a cyclical sector, but it acts much more like the mega cap sectors like technology and communications, because it's really ruled by Amazon and Tesla, both mega caps. So that's the only one missing from here. Otherwise, these are the cyclicals that have led this rally off the October low, which is right over here. You can see the cyclical sectors, and this again is an equal weighted index of them, made a higher low right here as the S&P was making a lower low into October. So that's a positive divergence, and you can see how they led all the way up to this area where the S&P stalled out at 4,100. Tried it once here, tried it twice there. If you look at the cyclicals, you can see the first time they had support here, the second time they weren't acting as well over here. They were a little bit lower. But look where we are now with the S&P coming close to trading at that 4,100 level again. But more to the point is how I've been looking for the mega caps to start participating, which they really haven't done in the last year. Like 2022, they've been acting horribly. So I'm going to change this to the mega cap index that I have, and this is just my own equal weighted index of mega cap stocks. And what I want to point out here is how they were doing fairly well. They're kind of keeping pace with the broader market into this August high. But as we come into this area where the S&P failed twice, what you can see is they're already showing a pattern of relative weakness. And by that second test of 4,100 compared to back here, you can see they're quite a bit lower. But as we come into the new year, right here around January 3rd, the first trading day of the new year, You can see them ripping higher and already above where they were back here when the S&P was testing 4,100. So this is just more evidence of the mega caps starting to participate. Now, I really don't care about, how they look on, long-term basis, like over a year or whatever. What I'm looking for is changes in character, changes in tone moving forward. I don't care what has happened. I care about what is happening. And as you can see, these mega cap stocks as an equal weight index are already above where they were when the S&P failed at 4,100. Plus, we have the cyclicals that I just showed you acting just as well as they were, if not better. One of the things I want to touch on is the measured move. So in the prior video, January 15th, in the beginning of the week on Monday, had a measured move of 4,000 for the S&P, and it tagged it by Friday. So as we came into this week, on Monday of this week, had a measured move. Let me show you the post that it was in. So this was just after 1 o'clock Eastern time during Monday's cash session, and saw a consolidation phase, and were able to start to come up with a measured move from that consolidation phase. So I'm pretty happy to say that almost all those measured moves to the upside have been hit as of Friday's close. A few, just a little bit shy, 1/3%, 0.5%, something like that. But still, the point is, this is not just guessing or looking at where resistance is and saying, well, I think it could go there. It's actually information from price action that tells us what the most likely target is in terms of a percentage move. And for the S&P 500, like I said, we came into the week with this 3,900 area, saying I'm looking for this 3,900 level to be tested again, but to make a higher low, which is right here. And then we just take off to the upside. And the start of this consolidation right here, which turns out to be a bull flag, is what gives us our measured move for the rest of the week, which the S&P 500 came, within 0.5% of by the end of the week. But there is one concept I think is very valuable that I do want to point out on this chart, on the NASDAQ 100's chart. So we get a bull flag. So often I talk about head fakes or failed breakouts or failed breakdowns leading to faster reversals. So what we get is this kind of bull flag showing up where, again, we get the measured move from early in the week on Monday. And then we get this break just slightly below it. You can see right here. So this is drawing in shorts. They're seeing this pattern break down. They're jumping in. We had a market signal give us some information that this was most likely a false move, which was high yield credit. But the point is, when we do get these false breakdowns or even a false breakout, they often turn around very quickly and reverse to the upside, or in the case of a false breakout, reverse to the downside. So we had this little area, which I would just describe as a bear trap right here. And then as prices start to move back up above this flag, all these shorts right here start to cover, and it gives the market a lot of momentum to the upside, which we see the rest of this week. So from these failed moves often come fast reversals. We see that in the S&P 500. We also see that here in the NASDAQ 100, where we have a very tight, very nice looking bull flag. And here we go with that kind of breakdown below the bull flag. That again was a false breakdown. So false breakdown, bear trap, led to a fast reversal. So all these new shorts entering here are getting squeezed as price comes back up here, and they are helping to power this momentum, this reversal to the upside. So for my subscribers to Wolf on Wall Street Trade, you already know what the measured moves are. They were posted yesterday, they were posted Monday, they were posted this afternoon. Again, the most likely scenario after a measured move is hit is for price to correct or consolidate, which we saw if you watched the last video on January 15th. The S&P tagged our measured move at 4,000, but rather than consolidate, it corrected, but not a problem with this correction because it is a higher low, not a lower low over here. And that's where we get the rebound into this bull flag, the little bear trap here, and another move higher. So once we hit those measured moves, are pretty close to them, the next thing you can expect is for the market to consolidate in the area of that measured move. On the week, there were some hugely important, very important developments in the market in levels that were taken out. So let's start with the S&P 500 since we're here. And this is a daily chart with the 200-day SMA in blue. So one of the things you can see is that since April, the 200-day has been resistance here, here, over here. This is the two tests of 4100 that failed and our correction over here. And we can see it break out. But it is a technical achievement. It is something. But what is more important to me, let me just take off this 200-day real quick and I will show you what's more important. And that is this trend line, which is the primary bear market downtrend from 2022. So basically January here, the highs. And every time the S&P has come up to this, it has been turned back, especially right over here at 4,100 once, twice. But as we look at this week, what happens, it's like breaking out above that trend line, that primary bear market downtrend. So if you're a regular subscriber to Wolf on Wall Street Trade, you know we saw a change in character in August. We saw a base in October, and we're looking for the market to turn intermediate trend, not primary, but intermediate trend sideways, which we can see in small caps already. So if we look at small caps, here is kind of the bear market, and here is the turn to lateral in the intermediate trend. You can see July, October lows are about the same, and we have this more lateral intermediate trend, not primary trend. So I don't think this is quite, anything like a bull market or a bear market low and base or anything like that. But I think it's something different than the typical bear market rally like we would see right here. And we expected this actually in August, got kind of evidence of the base in October, and then we've been actually rallying since then. You can see small caps actually have been lagging on this rally compared to some of the other averages. But to get back to the S&P 500, I think this really is a major development. So if I zoom in a little bit closer, you can see at least 2 days above that downtrend, that primary downtrend. Now, again, to me, this does not mean that the bear market is over, but I do think it's turning a little bit more lateral in the intermediate trend. The NASDAQ 100, which is full of large cap tech and mega caps, had its own little technical success story this week. And here it is with a 200-day moving average. And you can see the 200-day really is kind of acting as the primary trend. And it's also acting as resistance. Over here, we couldn't even get up to that, nor over here. But the last 2 days, we have been above that 200-day moving average. So the S&P 500 is breaking above the trend line of its primary downtrend or bear market. And the NASDAQ 100 is breaking above this 200-day moving average, which it has not been able to do during this entire bear market. In fact, what we can see, looking at the leadership that is just developing in these mega caps and helping NASDAQ, we can see the S&P 500 just shy of that 4,100 level where it found resistance in December twice. But if we look at the NASDAQ 100, here's that kind of same zone of resistance rather than an exact level, 12,000. That's a nice round number. It seems like a good trend line. But this is a zone of resistance, and you can see prices traded just above that. So we're starting to really see the NASDAQ 100 and the mega caps kick in as far as leadership, whereas all of last year they were major laggards. And the reason this is important is because they are heavily weighted stocks in these cap-weighted indices. Like I showed earlier in the video, we not only have cyclicals that led this entire rally from October, but now in the new year, we have cyclicals and mega caps performing well. So that suggests to me there's a really good chance that the S&P 500 does break above that 4,100 level. I want to jump to my proprietary indicator 3C real quick. Take a look at that, what's happening there. Here you can see, again, this is the area where S&P tested 4,100 twice, although we're looking at QQQ, and failed. And one of the things that stands out to me is that NASDAQ really wasn't seeing strong 3C support over here, But as we come into the new year, right over here, let me grab a drawing tool. What we see is a positive 3C divergence into this December kind of range or low, and that leads the market higher. Now look at where 3C is right now. So QQQ or NASDAQ is basically around the same price levels, but look at how much higher 3C is here than it was back here. This is showing this kind of renewed strength in the mega caps, in the NASDAQ, this rotation that I've been talking about and looking for, I don't know, 2 months or so. And I want to show you one other thing that is really jumping off the chart. So market breadth, let's take a quick look at that. So what we have here is the S&P 500 and the percentage of NYSE stocks that are trading above their own 200-day SMA or simple moving average. You can see into the record highs over here that basically what we saw is fewer and fewer stocks participating. This happened all of 2021. Really ugly market breadth. But as we come into 2022 in this October low, it's starting to shape up a little bit. But look at it over here. I mean, this is spectacular market breadth. If I just roll this back a little bit, you can see that this is basically the best market breadth or reading in this one indicator since July or so of 2021, when we're in the midst of a raging bull market. So when I see breadth this strong, it becomes very difficult to make a case for shorting the market. I'm not a permabull by any means. I usually lean more bearish or more skeptical of the market. But this is just a very strong signal from market breadth, which tells us this is not the 5, 6, 7, 8, 9, 10 mega caps leading the market. This is those cyclical sectors that have been leading since October, still participating. What we have going for the market right now that we didn't have the last time the S&P tested 4,100 is the mega cap participation. So from January, the mega cap index, I'm just using MGK to keep it simple, is up 11% for the year, while the S&P equal weighted index is up about 6.7%. Last year, at just about any given moment, the S&P equal weight index would have been outperforming the mega cap index. So that's a real big change in character as we've come into the new year. That's most likely because the market has seen or is experiencing or perceiving peak inflation, which also means at some point peak Fed hawkishness and peak rates. What has really knocked these mega cap stocks down all of last year was rising rates, because they have very forward-looking valuations and very rich valuations. So those had to be marked down. The mega caps leading over here well above where they were at the last time the S&P tested 4,100 is a really big deal, big development, and it did not come at the cost of the cyclicals. It came out of the defensive sectors. So next week will be a big week. We have the FOMC, the Fed announcement on Wednesday. We have the Bank of England and also the European Central Bank with their policy statements coming out next week. And we have the very key, very important payrolls coming out before the open Friday morning. We also have Amazon, Google, and Apple all reporting earnings on Thursday. So that's going to be a big event to watch. There's a lot of big stuff happening next week. This is kind of why I think, we will hit these measured moves, which we're really close to already right now, and kind of go into a consolidation phase in front of the FOMC, maybe in front of those earnings for the mega caps on Thursday. And if everything goes, halfway decent, I think we can see the S&P 500 easily trade above 4,100. And what that will do is it will keep this trend of higher highs and higher lows alive. So we'll have to trade above 4,100. That will keep this sub-intermediate to intermediate price trend, bullish price trend alive. So again, this would be the next real huge accomplishment, is to cross 4,100. Now, do I think this is the start of a new bull market? No, I don't. I think that This is phase one. The market is looking at peak inflation and peak Fed hawkishness. And when it sees that, which is starting to see, it celebrates it. That's why we're getting this rally. Then we're going to move into a recession phase. And I think at that point, we'll see the market turn from this kind of intermediate lateral trend back down to a primary bear market. And then at some point, probably early 2024, we'll be looking at the start of a new economic cycle, a new bull market. But first, we have to go through that recession, which we haven't hit yet. And then, well, actually, we did for 2 quarters, but it's not recorded as a recession this past year in 2022. In any case, we will hit that recession, I think, in the second half of this year. So it's going to be a very interesting market, a lot of opportunity to trade on the long and short side, but you don't want to be a perma bear, you don't want to be a perma bull. You want to take what the market's saying, the message, and align yourself with that and be on the right side of the market. I've got a lot of emails this weekend saying, hey, thanks for keeping us on the right side of the market from subscribers. And again, I usually lean a little bit more skeptical, a little bit more bearish, but I've just been following the developments, and we've really seen since this October base here, this potential for a nice rally. In any case, I've gone way past what I thought I was going to. I think I'll have that live stream up by next weekend. I hope so. And then you'll get a few days notice. If you want to partake in that, make sure you subscribe down here. There's a subscribe link to my channel. Also hit the bell for notifications. That will let you know when the live stream event is coming up, and you can participate, ask questions, whatever you want to do. In the meantime, if you have questions or comments, just go ahead and leave them in the comment section below, and I'm more than happy to try to get those answered for you. Have a great weekend, everybody. Subscribers, I will see you on Monday.